Ken Shinoda joining us right now, portfolio manager over at DoubleLine Capital, and that's really going to be the parlor game, I guess, for the next few months. I mean, yeah, some point this year, that could mean the March meeting, that's off the table. It could be the May meeting, it could mean December. Do you have any confidence right now, A, that the Fed will follow through on at least one rate cut this year, and if so, why?
Probably cut 3 times. That's what they've been telling us they want to do. I think the SEP plots are what their intentions are if the data allows them to. And going into this meeting, we definitely didn't think they were going to do anything today, and we were highly unlikely that March was going to be on the table, and Powell himself said that's unlikely. So it's wait and watch the data, see how that comes through, but higher for longer should continue to slow growth, should continue to help inflation stay low, and on a 3 to 6 month basis, core PCE is now sub 3% on the way towards their goals.
I am curious about sort of the market, the environment for trading around this. We know that uncertainty has created a lot of volatility, and one of our reporters at Bloomberg had a chance to catch up with one of your colleagues at DoubleLine, Greg Whiteley, and I thought he had the great quote. He was talking about how this decision kind of puts a floor under that volatility, meaning it will continue, and basically saying rates, spreads, liquidity, I'm quoting him, will all be choppy.
I mean, I think we lived in a decade of the best liquidity we'll probably see when we were in peak quantitative easing and the Fed was buying treasuries and mortgage-backed securities. And as we come out of that and we normalize into a world of, no QE, into a world of higher Fed funds, a more normal Fed funds rate, I think that we'll be in a more choppy, volatile environment. And 2024 will be that environment.
We have some pretty big swings in treasuries today. I'm looking at the short end, the 2-year yield down 12 basis points. And if you look at the movement since the 2 p.m. announcement, it's pretty much been all over the place. Tell us a little bit about what the positioning looked like heading into today's trade and how the headlines that we got out of New York Community Bancorp may have exacerbated things.
Yeah, I don't like to read too much into price action on Fed Day. I think the market needs some time to digest things. I think there was a lot of players perhaps just short the front end in case there was something unexpected that happened. And then once you saw that news this morning on the New York Community Bank, I think that led to a short covering that created that vol on the front end. So I think we want to wait and see how things shake out. I think it's likely that the front end probably heads back a little bit higher given Powell's stance on staying higher for longer.
Yeah, absolutely. Powell also made really clear that he doesn't see a need for the Fed to cut rates, because of real rates rising. So I'm wondering what kind of scenario would require the Fed to move sooner, perhaps in March or certainly before June?
Well, they need some type of negative event. They need an economic shock that would cause them to want to cut rates more aggressively. Right now, it's hard to predict what that is, but I think we're going to be a little bit of smooth sailing here in the near term. But things have gotten a little bit overbought. Stocks are at all-time highs. Optimism for risk assets is very high. Even the credit markets have run pretty dramatically. Investment-grade corporate bonds, high yield, have all gone really tight in spread. They're kind of like 10th to 12th percentile on a 10-year look back. And so we're a little cautious here. Some of those assets we talked about on the last Fed meeting in mid-December that had lagged the market, like non-agency mortgages and commercial mortgage-backed securities, CLOs, those non-traditional parts of the market, have been playing catch-up. And so that's played out, and now not much looks too cheap out there.
So in that environment then, I mean, not too much cheap here, but there, of course, we talk to a lot of folks. They talk about some of the tactical opportunities, particularly given the volatility, but also the idea that even longer term, if you are betting on a drop in rates and more importantly, economic conditions that will at a minimum at least be stable here, is there a case though for entry points right now, whether it's in high quality fixed income or longer duration or something like that?
Absolutely. I mean, from a long-term standpoint, the Treasury curve is at levels we haven't seen in over a decade. I know over the last couple of years, we've seen this positive correlation with stocks and bonds, which typically exists when CPI lives above 3%. But with CPI coming down 3%, I do think that negative correlation of stocks and bonds kicks into the safety of bonds and the risk off. So I do think that high-quality fixed income, especially treasuries, look really interesting today. You don't have to go all the way out the curve. The belly of the curve should benefit the most as the Fed cuts, kind of that 2 to 5 year portion. And so I think investors should start, and we talked about this last time, you got to start coming out of those T-bills. I know they're still attractive.
No,
you got to
Ken.
start coming out of those T-bills.
No, Ken. There's some of us who are just scared of everything, Ken.
Ken Shinoda, portfolio manager at DoubleLine Capital.
To take risks.
Yeah, well, urging everyone to maybe, put your toe in the market and, come out of T-bills. Maybe look at, taking on a little bit of risk.